Let's, on that note, welcome our market master for the day, Naren, CIO of ICICI Prudential AMC. Good morning, Naren. Good to have you with us. Well, the first advice that I guess all investors would want to know is, should we be worried about the kind of fall we saw? The Nifty has moved a distance away from that 8630 mark. It's high touched not too many days ago. Is the bottom likely to be 8,000 or 8,200, or should we be a little more worried?
So I think first let me wish CNBC and its viewers a happy 15th year celebration.
Thank you, Naren.
I mean, I've seen equity markets in the pre-1999 days, and the markets have changed so drastically. And I think CNBC is certainly one of the catalysts in that change.
How kind of you.
So as far as the market is concerned, clearly I can tell you that, most Indian investors actually were looking forward to a correction. Because, most Indian investors are still underinvested in equity. And the correction actually gives them an opportunity to consider investing. And so I think, whether the market corrects for some more time or not is quite, I would say, not very material, because if you see the situation at this point of time, with the current price of crude, India is the most attractive emerging market in the world. And therefore, any correction due to whatever that is happening globally is actually an opportunity for people to invest for the long term in Indian equities. So I don't see this correction as anything much to worry about from an Indian investor point of view.
Okay. Naren, hi, good morning. First of all, thank you for those kind words. I mean, amidst all the highs and lows in this market, you've been one stable voice for our viewers and investors. So thank you for that. But even if we do see a bit of a global scare and our markets fall in tandem with that, what should you be looking to accumulate? What are the pockets that will stand out the most in terms of a buy on every dip?
See, clearly the two things where we are very bullish with a 3-year view is India and US dollar. And so anything which is very dependent on India and is likely to benefit from the continuing strength in US dollar, these are the two kinds of things that we like. If you see purely from a point of view of correction, I think recently technology has corrected. So while it is not dependent on India, I think the correction in technology does give you an opportunity to invest in technology. So that's one thing which is very clear. And I think most of the Indian cyclical sectors, I think there is a huge role to invest with a 3-year view. The Indian defensives, they have been costly. We've been underweight, they become costlier, and so it's very difficult with the kind of research process and fund management process to recommend stocks which are trading at 40 and 50 times trailing, even though their outlook would be good. So I think that's where we've been trying to be defensive. See, as far as commodity is concerned, I think today they become contrarian buys. But as you know, with commodities, if you know the bottom, I think if you had carried any audience poll or any analyst poll or any poll, no one would have come and told you that crude will come to 65. So I think that's why I would say, but still I would say things like commodities now are looking pretty attractive with a long-term view. The short-term view looks very clouded, because we have seen that it's possible that some commodity country may get into deep trouble and cause further fall in commodities. So that's why the near term is not clear, but long term I think slowly commodities is becoming attractive.
Okay, well, I want to come back to the sectors question, which clearly is more interesting. But just a word more on how you see the global picture itself. We've got a minor scare, but if commodities were to dip further, or if Chinese inflation numbers came in lower, or growth numbers came in lower, or if Greek and political problems sprung up elsewhere, I mean, whatever the combination you can look at, what are the chances that the global scare is going to be worse than what we are prepared for?
See, first I'm not able to understand if inflation goes down because of the fall in crude oil prices and the millions of citizens across the world, they get benefit in the form of lower petrol and diesel. Is it bad for the economy or is it good for the economy? So I think this talk of deflation due to the fall in price of crude oil I find is pretty funny, because I think it benefits most citizens across the world, whether it is in Europe or US or India. So I would say this worry about deflation is not a worry for me at this point of time. I think one worry which certainly we are hardly equipped to talk about is the fact that there could be some commodity country, just like India is gaining $3.5 billion per month due to the fall in crude oil prices. I'm sure there are other countries which are losing $3 to $10 billion per month because of lower crude oil prices. What happens to them? Do they have adequate resources? Are they in deep trouble? Are they going to sell the assets that they hold in other parts of the world? These are questions for which I don't have clear answers, but they could be the source of a problem over the course of the next 1 year. But to an investor in India, I think it's an irrelevant problem, because that's actually, those people selling is due to their problem, not because of India's problem. So if there is selling due to that, we should buy.
All right, that's a fair point. So what should the asset allocation strategy be, Naren, for 2015 for the average Indian investor? How bullish would you be on the fixed income market, on debt funds, and do you think the returns from the fixed income market could be higher than equities in 2015?
So in your Diwali show, I got a chance to actually recommend fixed income, and today as we speak, you know, fixed income has done so beautifully relative to equities that no one would have ever believed that. But going forward, you know, I believe that the way the market is positioned, I think equities is a fantastic 3-year asset class. And maybe fixed income is a fantastic 1-year asset class. This is what we've been thinking, and but the way fixed income markets have rallied, you know, it's just unbelievable. I don't think anyone would have imagined this kind of rally. But we saw the market as being extremely attractive. Now we see it as being attractive. The disadvantage in the fixed income market, in my opinion, is I think the attractive phase is the next 12 to 18 months. Whereas if you see the equity market phase, it is the next 36 months to 60 months. So 3 to 5 years. So I think and it's always much better for a mutual fund to give long-term investment calls. And that's why maybe today again we go back to equity being a more attractive asset class at this point of time.
Okay, yes, we clearly remembered what you told us on Diwali Day, which was why we posed this question to you. Naren, you know, you spoke about, when Sonia was asking you about sectors you like, you spoke about IT and pharma, the defensives. Is this a time when you would not get into Indian domestics or cyclical, say PSU banks or infrastructure or the smokestack stocks? Are you still not convinced about the growth story or its timing? Or are you picking up there?
Actually, for a long time, one thing I must point out is we've been actually very, very positive on pharma. But pharma no longer is as cheap. And in fact, IT looks much cheaper than pharma. That's one thing I want to add.
Yeah, you said that.
As far as the domestic cyclicals is concerned, you know, you have a situation where you have to raise capital. The PSU banks have to raise capital. You know, if the market believes that the capex cycle is going to start in the next 6 months, I doubt it. If you see the situation today, why would anyone want to invest so much in energy and metals and those kind of capex? So it has to be only infrastructure capex, and that means that, you know, an infrastructure capex has a lot of problems still to be resolved. So our belief is 16 to 19 is the period where infra capex will take off. The near term, I think all capex is still at risk at this point of time. So, you know, if you have a 3-year view, I think you should start accumulating these kind of sectors. And in PSU banks, I think we have to wait for the capital position to improve across all the banks. And if that were to improve, I think that sector also becomes better. But then, you know, they have NPL issues to be resolved, their capital issues to be resolved. There are a lot of CDR related issues to be resolved. So, you know, it's not such an easy pick at this point of time.
The big game in 2014 was the mid-cap space, Naren. Huge outperformance there compared to the frontliners. Do you see that trade get replicated in 2015, or do you think the tables will turn?
See, there are some mid-caps, which are quality mid-caps, which today trade at 50, 60, 70 PE. So, our research process, when you see stocks at 50 to 70 PE, even good quality ones, we tend to be a bit cautious. But what we thought was costly at 50 PE has become now 65 PE. So now at 65 PE, am I going to change my view? I don't think our research process will allow us to now turn bullish at 65 PE. So we'll continue to take the pain of outperformance of some of these stocks. To me, I think both large cap and mid caps are both equally attractive today. And the way mid caps and small caps have got re-rated in the recent past, I think it is difficult to believe that every year you're going to have this kind of outperformance. I think there's been a 40% difference between small cap performance on 1 year and Nifty on 1 year. So I don't think that kind of return gap is going to continue each year. And that's why I would say all capitalizations are equally attractive and not very different from each other. And but at the same time, I think the three-year view on all these are looking good. But I'm not a big believer right now that small caps is much more attractive than large caps with a 1 year view.
Fair point. Naren, always a pleasure speaking with you. Thank you very much for joining us with that many-sided perspective on macros.